Hello everyone, welcome back to Navalier Market Buzz, episode 38. I'm Crystal Navalier and I'm joined again this week by my father, Louis Navalier, but we have a very special guest, Paul Hickey, who is the co-founder of Bespoke, and he's also a frequent and popular guest on Bloomberg, CNBC, CNN, and Fox Business.
Very excited to have Paul. We subscribe to Bespoke's research. We are absolutely hooked on their charts and all the details they provide. Paul is a phenomenal historian of the market. So this is a very exciting interview.
Paul, can you explain how you found the 26 triple plays during the current earning announcement season and what makes them so special?
Sure. So let me just start off by describing what a triple play is. An earnings triple play is a company that will report better than expected earnings, better than expected revenues, and then also raises guidance going forward. So these companies are, very impressive in the fact that not only are they reporting better than expected results, they also have confidence in their outlooks to raise guidance above what the current consensus is forecasting. So we like to focus on these companies on a quarterly basis and look for new ideas. And what's really impressive about this quarter is that we found there's been a total of about 80 triple plays so far this earnings season. And when you look at where this earnings season fell in the grand scheme of things, it was right as Liberation Day was announced with the tariffs. No one was really expecting any companies to raise guidance this quarter. We were just expecting a lot of lowered guidance, but we actually saw more companies raise guidance than lower guidance. So it's just been a really impressive earnings season, something we wouldn't have expected. And so that's the background of what a triple play is. And then the report we just recently published where we highlighted 26 of these earnings triple plays is like what we like to do is look for companies that have interesting business models and that most people may not have necessarily heard of. And so to give people an idea for further research. And so take one of the names, Cadre holding CDRE. What they do is they provide equipment for law enforcement, military, and also nuclear facilities. So with the explosion of data centers that we've seen over the last couple of years and needs for alternative energy, nuclear has become very popular. Some of these nuclear stocks have taken off, but maybe some investors haven't thought of necessarily to focus on companies that supply these nuclear facilities with equipment and safety equipment.
Paul, the Bespoke 50 stocks have also crushed the market averages. What makes those stocks so special?
Right, so they're generally growth stocks. We start with the Russell 3000, and we'll look for companies that have strong earnings growth in the past and also expected strong earnings growth going forward. And then what we also do is we overlay a technical screen on top of those. So our view is always that the more disciplines that you can see an investment opportunity look attractive under, the better chances your success will be. So we combine those to come up with these 50 stocks each week or couple of weeks that we publish. And then growth has been a very strong area of the market over the last several years. So I think that has helped the overall performance. But again, these companies aren't necessarily the largest cap companies, but they're not micro caps either. They tend to fall in the middle of the road.
I should add that on the Bespoke 50, we overlap with you on Niagen Bioscience, so that's NAGN, Planetary Technologies, PLTR, and then Sezzle, SEZL, and congrats for finding Sezzle, because that's been a wild ride.
Yes, and so that's three disciplines it looks good under. That are the two we just mentioned, and under the Navalier approach. So that's even better. And yeah, so the Niagen is this whole health span. We focus so much on extending lifespans, but not the health span of people. And Niagen is looking to get into the cellular makeup of people, metabolism, cellular repair, and that type of to make people not only live longer, but be healthier longer.
Now, Paul, can folks manage accounts that follow your triple play and Bespoke 50?
So not specifically. So for both of these approaches, what we do is we always refer to them as starting points for further research. So Within our managed accounts, we have a growth strategy, and there's a lot of overlap in the approach we take for the growth strategy. So you'll often find that there'll be some stocks that are in our Bespoke 50 that will show up in our managed account process over time. So there's some overlap in the methods of looking for potential investments. And as far as the triple play strategy is concerned, we have a triple play approach where what we do is we not only look at what a company reported this quarter, but we look at the historical patterns of how that company has reported their frequency of triple plays, whether the pace of triple plays is accelerating or decelerating. And so we do have a specific triple play strategy that we approach. So it's not an exact replica of these lists that we put out, but there's very a lot of overlap in the approaches.
So, Paul, I'm hooked on your reports when the S&P makes a big move. You go out and study how often that's happened historically and what the historical performance has been over the next week, month, 3 months, 6 months, and year. But with that said, aren't we overbought now that we've just had this huge semiconductor resurgence?
Yeah, so I mean, we've had a major rebound in the markets overall off the April lows, but again, you have to look at what preceded that rally. Semiconductors, like you said, have rallied 20% off the lows, and there's only been about 10 other times where they've hit a 52-week low and then rallied 20% over the next month. Over the next 6 and 12 months, returns were positive. 6 months later, the semis were positive 80% of the time. Year later, their median gain was 47% with positive returns 70% of the time. So not a perfect track record, but healthy gains. But to your point about this, how we've had this, sharp rally, I think this is really the most fascinating thing we saw in the last week or so here, is that you look back in mid-April, the S&P was down 15% year to date. We're now up on the year. That has rarely happened in the post-World War II period. It's only happened in 4 other years where you've been down 15% and then rallied back to erase that all before year end. And that was in 1970, that was in 1982, and that was in 2020, and then 2008, 2009. I did the order wrong there, but those were all big years for the market, and they were followed periods of great uncertainty. In 1970, we were coming out of a Fed tightening cycle and the Vietnam War. In 1982, it was Paul Volcker's hard money period where rates were jacked up. We self-inflicted the economy into a recession to break the back of inflation. And then in 2009, you had the coming out of the financial crisis, and 2020 coming out of COVID. And so all those periods, when you got back to positive for the year, there was probably this feeling that, wow, we've come a long way in such a short period of time. The market's probably due for a breather here. So there's still a lot of uncertainty looking forward, coming out of the financial crisis in 2009 and COVID in 2020, are we going to have a resurgence? What you look back at all four of those periods, those prior periods, 3, 6, 12 months later, the S&P 500 was higher every time. And then if you even widen the lens to look at periods where the S&P 500 was down 10% year to date, and then erase that decline before year end, you get about 8 different years. And again, 3, 6, and 12 months later, the S&P 500 was higher every time. There was some weakness for the following week and month, but you tended to see. But once you got off, that period of digesting that big rally off the lows, the market tended to go higher going forward. So I think these types of reversals don't happen very often, and they're usually a strong signal from the market.
Now, Paul, I was captivated by your recent VIX chart. When the VIX gets low, doesn't it sometimes precede a market sell-off?
Yeah, so it's interesting when you look at the VIX. There's signs there's talk about how when the VIX gets really low, it's a sign of complacency setting in for the market. And when you have complacency in the market, you always increase the odds of a market pullback. Just as high levels of bullish sentiment are a time to, when everybody's feeling, good about the market, you should probably start, looking the other way. But that's more when the VIX gets down to like closer to 10. We're still in the high teens here in the VIX. And what's fascinating when you look back at history here is if you look at periods where like we went above 60 on the VIX in April. We were still above 40 in mid-April. And then on May 12th, we went below 20. So that was the fastest reversal from plus 40 in the VIX to under 20 that the VIX has ever seen, and that goes back to 1990. And there's only been, again, looking at history, 4 other periods where you saw the VIX go from above 40 to under 20 in the span of 100 trading days or less. Again, you had positive returns going forward over the next 6 and 12 months. They weren't shoot the lights out returns, but they were consistent returns in line with historical averages. But what's also was really interesting about this is you look at the VIX itself after those declines. In those 4 prior periods, over the next 6 to 9 months, 6 to 9 months later, the VIX never got above 30 again in those periods. You had to go 9 months later to get a rebound back in the VIX to above 30 and a rekindling of the high levels of volatility.
Paul, you're an expert in seasonality. Assuming the Fed gets around and starts finally cutting interest rates, can we avoid the seasonal weakness that all too often occurs in August and the first half of September?
Yeah, so I mean, I think there's a lot to sort out between now and the summer months, and the summer months, those August, September periods tend to be, weak periods for the market. I think, this gets to the whole idea of sell in May and go away. Historically, these summer months have been a weaker period for the market, but they aren't necessarily a period for that, May to October, where the market has averaged declines. It just hasn't been as strong as it normally is in those other 6 months. But I think as far as the market is concerned, going forward to August and September, seasonality is just one ingredient, and you have to take into effect what else is going on. And I mean, between now and then, I think we could see a lot change in what's going on. So it would be, just to look forward to August and September now and say we're going to buck that trend. I would probably, stay away from that until you see what's going on at the time. But I think you could see a situation if these tariff levels remain relatively low like we have now, and we don't see another tweet or Truth Social post jacking rates up again. The market and the economy could be faring well, where you could see the Fed start to lower rates. And then if that was the case, I think that would set up a positive market backdrop. But it depends on where we go from here to there, what we're going to do then.
Has the risk of recession dissipated with the improvement of retail sales?
Yeah, so I mean, everybody's looking for a recession. The odds have been talked up so much lately, but the consumer so far has been hanging in there. Jobless claims continue to remain, healthy. The last place where you're going to find signals of a recession, though, are in the economic data because it's backward looking. So, but I think jobless claims are the most real-time indicator we have, as they only have a week lag. So I think that's the indicator to be watching. But as far as a market-related indicator to watch is the price of oil. And this is sort of, counterintuitive. Oil near 2-year lows, you can look at that one of two ways. From the glass half empty perspective, you could say, oh, well, oil's weak because the economy is going down the tubes. So, that's one way to look at it. But again, if you look back at history here, when oil prices are near 2-year lows, that never happens ahead of a recession. More often than not, you have oil prices near 2-year highs leading up to a recession because it's those high oil prices which, break the consumer's back and cause them to retrench spending and not be able to spend on other items. So the fact that oil is actually near 2-year lows, I think, is much more of a tailwind for the economy than a headwind for the economy, and will hopefully help to offset some of the negative impact of the higher prices that we're likely to see from tariffs going forward.
Now, I have a little bit of a hard question. So, since private
Uh,
credit is yielding up to 11% due to leverage, is there any chance that private credit crashes and becomes the next black swan event?
Yeah, so again, if you were to see the economy really weaken from here, I think private credit could become an issue. But private equity or private credit has such, seems to be, connotated with as being so much more exotic than it really is. And it's really stemmed from the fact that bank regulation was so high in the post Dodd-Frank environment that companies went to other avenues because banks weren't as willing to lend. So I think in most cases, there's a lot more responsibility on the part of the lenders, and you're not necessarily seeing as reckless behavior. But again, if you were to see the economy really go down the tubes here, I think the private credit market could become an issue. But that's that at this point, we're not at those levels.
So, one last question, Paul. We seem to be in a stock picking market rather than a sector market. So, do you think your bespoke 50 and the triple plays are poised to keep leading? I mean, do you think the stock market will ever return more to a broader sector based strategy?
Yeah, so I mean, I think now where you have, I think at least our bias is towards the individual stock level. The whole ETFs should make sector-based, investing much more popular, as you can just invest in, one sector or the other. But the problem with that is that even a sector that has the greatest tailwinds going for it is going to have bad management at certain companies in it. So, those companies, even, when the coast is clear, they're going to find ways, some companies are going to find ways to mess things up. And so we're much more concerned about focusing on individual companies, especially when you have this type of technological change going on right now with AI, which there's certain companies involved in AI, but more importantly, you're going to look and find in certain sectors of the economy different companies utilizing AI to a different degree, and that's going to make them much more efficient. We constantly think that AI is, just 2 years old after the launch of ChatGPT, but companies have been using that for much longer. I mean, Google, or Alphabet as it's called now, when Sundar Pichai became the CEO back in, I think it was 2018, he said we are an AI first company. So AI has been around longer. Companies have been trying to use it more. It's really blossomed in the last 2 years, or actually 3 years now. We're approaching, but time really flies. But I think you want to look at companies, how they're utilizing this to their advantage.
My publisher had a big ring call yesterday, and the AI did most of the talking. It was pretty bizarre.
Oh wow.
And so we all kind of have the heebie-jeebies right now.
Yeah, nobody's going to need us, right?
Yeah, we're still recovering from this.
But the writing of AI still, I think, leaves a lot to be desired. I think you can, it's good for starting points, but a lot of times you can see, I mean, at least, you can tell what's being written by AI often and what's not.
Well, we use a lot of your research, but how can our watchers learn about Bespoke and learn all about your important research?
Yeah, so we provide different services on the research side to clients of all different types, from the casual investor to the pension fund manager to the hedge fund manager, to the largest institutional investors. So we have different levels of service that cater to everybody. And they're at all different levels of accessibility in terms of price. We also have a free blog on our website, bespokepremium.com. So people can visit us there, see samples of everything we have, and get a taste for the types of analysis that we do on the markets and individual stocks. And then we also have a Twitter feed, or an X feed. It's at Bespoke Invest. So those are on the research side of things. And then we also, as you mentioned earlier, we have a wealth management group where we will manage individual accounts for investors, with taking a growth bias and a growth approach to the market.
Yeah, Paul, I have one suggestion for you. Since your returns are so good, I don't know if you're doing it yet, but a lot of our managed accounts, we will manage money for just 10% of profits billable annually. It's
Hmm.
SEC Rule 205-3.
Right.
So for your special portfolios that are extra powerful,
Yeah.
you might want to offer that. Of course, they have to be accredited investors. You have to
True.
wait a year to bill, but it's based on their actual account appreciation on a
Yeah.
trailing 12-month
That's a good
basis.
good thing to look into. We'll check that out.
Well, it'll make you just as big as those big hedge funds. Yeah.
Yeah. Yeah, but once they get big, you look at their returns, it's not even worth it, right?
Well, yeah, that's why I never did him because I knew I just happened to know the reg, and
Yeah,
but again, you have to wait a year, and
right.
they have to be accredited investors.
Yeah,
So
oh, that's good. Yeah, we'll definitely check that out.
yeah, it's SEC Rule 205-3.
Now let's discuss the upcoming economic news next week. Are there any significant reports other than the existing new home sales?
Not that I know of. Just Trump has already announced that they're going to send out letters to countries explaining what their tariffs are going to be because they don't have time to individually negotiate with all of them. So I'm sure that's going to cause a bit of a interesting market response.
Yeah, I mean, I think that's the headline. There's still headline risk in the markets here, and that's things that where you just have to be on alert for. And unfortunately, you have very little way to anticipate when those are going to happen.
Now, earnings season is winding down, and there's been a lot of announcements recently. I'm sure everyone is very excited. Dad, can you talk about NVIDIA?
Sure, NVIDIA is the grand finale. Their sales are forecast to rise 65.2. Earnings are forecast to rise 42.3. So when the earnings aren't growing as fast as sales, it means the margins are getting pinched just a tad. But NVIDIA's, last I looked, 70% operating margins, so they're fine. They have a great earnings price history, but as always, their guidance is going to be crucial, especially in the wake of all those new orders they just got in Saudi Arabia. Paul, you're probably more an expert in why NVIDIA reacts funny after its earnings announcements. I think it's because, the Citadels and the big firms are writing all these covered calls on NVIDIA. So when it announces and beats, sometimes it doesn't want to go up because all the people that wrote these call options don't want to fill
Yeah.
the orders.
Yeah,
So
it's been really interesting to watch because it seems as the news has gotten better. The stock has been has been harder to achieve gains, and you know everything. The business is doing great, but to your point, Louis, like what you've seen is over since basically last summer. There, if you look at the chart, there's multiple instances where the stock rallies sharply on good news, and then the candle charts on an intraday basis show a sell-off, and looking for when the tide is going to shift on Nvidia here, you want to see that some of those rallies show further momentum rather than see that selling into strength. The stock has seen a pretty big haircut like the rest of the market, and it's rebounded from that. So maybe that's a step in the right direction. But I think you want to see that trend break of selling into strength.
yeah, I think 42% of our options are now daily. So it just sometimes appears the tail's wagging the dog. And of course, there's a lot of mean reversion programs on Wall Street to punish the winners. And unfortunately, as earnings season winds down, it seems those mean reversion programs get stronger.
Yeah, you get an environment where the market tends to rally in the first part of earnings season, so expectations get higher, and then it becomes, since they report so late, it's harder to beat what early in earnings season expectations are low, so you can beat the bar is set low. It's easy to get over it, but then as the bar gets higher and higher, it becomes harder to get over.
Yeah, great observation.
And what do you expect for Costco?
Well, their sales are forecasted to rise 7.9%. Earnings are forecasted to rise at 12.4. That's excellent. The analyst estimates are steady, but their same-store sales are crucial. Last I looked, they were a little over 7%. Costco retails a ton of gasoline, okay, and gas prices are down, so it could cause same-store sales to continue to slow. But Walmart, beat and gave some interesting guidance. They were going to raise prices, so because of the tariffs. So it's going to be interesting if on Costco's guidance.
What do you expect also for DELL?
DELL sales are forecast to rise 4.1%. Earnings are forecast to rise 32.4%. There's been some recent analyst trims, but DELL has a good earnings surprise history. The real question is DELL starting to make a dent in SMCI's AI water-cooled server rack systems. Now, Kramer has kind of gone off that, buy DELL, sell SMCI. I would respectively disagree with him only because the guys I know in the cloud and still love their rack system. So that's going to be the real key is what is their guidance going to be going forward, and are they making a dent in SMCI? Paul, do you have any idea who's winning the server farm wars?
I mean, I don't have much of insight there. SMCI, it's just, I was going to ask, do you think their issues on the accounting are fully behind them now? And it seems like they've gotten most of that behind them
Yeah.
at this point, right?
Yeah, no, it is. I never sold the stock. We're up 800% in it, and
Wow.
to be honest with you, we didn't want to realize the capital gain.
Yeah.
But when the Hindenburg report came out, I went through that forward and backward, and basically they got criticized for booking too many sales. And so they were booking things 4 to 5 years out. And then they're paying their sales guys, not delivering and squeezing their operating margins. And then, of course, their auditor resigned out of liability concerns, and then they blamed their auditor. And everything seems to be back on track.
Yeah.
But they did confirm everybody wants the Blackwell chip versus the H20. So, but again, our management company's out in Reno, and we have Apple and Google server farms out there, and we got all kinds of friends in that business, and they just swear by their equipment. So I stuck it out. I also wasn't seeing a lot of analyst cuts. So, but all that's over. Hindenburg's out of business now, and so that's that. So
Yeah, now they can get back on track.
I hope so. And they did get it.
It's still, I mean, it's still got a ways to go to get back to where it was.
Oh yeah. Oh yeah. They did get the Saudi contract, and I think the problem is their chairman is so obsessed with running his company, he doesn't often do the PR stuff and interact enough. And I think that's part of the issue.
Yeah.
Now, Home Depot has had quite an interesting past, but are you expecting positivity for them this week?
I hope so. Their sales are forecast to rise 7.5%. Earnings are forecast to slip 1.1%. But they've had steady analyst estimates in the past couple months. Although they missed last quarter, I think their guidance is going to be key. So in the April retail sales report, there were two green shoots. One is that spending at bars and restaurants were up 1.2%. So I think, Crystal, you and your friends helped that. And then hardware and garden centers were up 0.8%. So clearly people were out and about improving their home and all. And hopefully that'll show up in Home Depot's bottom line. And hopefully they'll give us some good guidance.
Yeah, and I think, what we're starting to see as well is you're starting to see, you saw such a pull forward of demand during COVID that you saw a lack of you saw a lack of activity or a decline in activity. But you're starting to see, as we get further from the COVID period, you're starting to see, as far as those big ticket items and renovations, people are starting to do that kind of thing again. And then the weather in the north, at least in the Northeast, has been terrible. But if we get we had a good weekend last weekend, get a good weekend this weekend, and that's going to really help their garden sales, which is major high margin area for them.
And lastly, do you expect a similar positivity with Intuit?
Yeah, their sales are forecast to be up 12.2. Earnings are supposed to be up 10.3. They have very steady analyst estimates in the past couple months. They have a very good earnings surprise history. Obviously, they're doing a lot more than just TurboTax. And I think, Crystal, the TurboTax founder is in our neighborhood, Reno. So that's Ranson. He's a great guy. But we were expecting good results from Intuit.
Perfect. Well, thank you both so much, and thank you so much, Paul, for being here. Please make sure to like, comment, and subscribe. If you want to check out any of Paul's links, they'll be in the description below. Also, if you want to check us out on Spotify, that link will also be in the description below. But until then, we will see you all for a new video. Thank you so much, everyone.